Market regulator SEBI recently allowed equity exchanges to start commodity trading as well. That move on one hand is expected to increase the competition amongst the existing commodity exchanges but also provide an opportunity for consolidation. CNBC TV18 spoke to MCX as well as NCDEX to understand these rapidly changing dynamics in the commodity exchange space. Thank you so much for speaking to CNBC TV18 at this ANMI conference. Of course, to start with, the biggest highlight as far as 2018 is concerned, and that came for the equity exchanges when SEBI allowed them to start commodity trading and so on and so forth. As an incumbent MCX, what kind of competition have you seen in the first 3 months from them starting commodity trading? As well as in 2019, how aggressive do you expect the competition to go if, you know, the kind of scale that they have started on, if that continues? What is your expectation in terms of the competition?
So I think we have consistently maintained that competition is something which brings the best out of everyone. Our own experience, and as you would know, that the previous quarter was the highest ever quarter in terms of turnover that we've had ever since the introduction of CTT. So we believe it sort of ties in with what we've been saying, that more exchanges means a larger pie for all of us to share. Our firm belief is that specific liquidity in contracts do not move, and therefore we are very, very confident that we will be able to maintain the liquidity that we have. We think the market will grow, and we think that's how all of us will benefit.
Right. Speaking about the first 3 months as far as the trading has begun at NSE and BSE, have you seen any shift when it comes to your market share in commodity derivatives? And if the competition intensifies further, which is also sort of the word on the street right now, what is going to be the strategy as far as MCX is concerned in terms of differentiating itself when it comes to the products as well as the strategy from NSE and BSE?
So I think what we have seen, like I said, again, ties into what has been a global experience, that liquidity generally does not move, even if there is some financial advantage sometimes. And I think it's A, because of the network effect. It's because of the fact that you have the liquidity and people feel more comfortable. You know, at MCX, people have used us, tried us. They know exactly what to expect. They have the experience when it comes to deliverable products of the fact that we can manage those. So I think that's something which is what we've seen in the last quarter. I think too early to say what strategies will be, right, and too early to discuss them in an open forum. But I think we are very well prepared for increased competition as well.
Okay. On one hand, of course, there's this whole idea and discussion about competition. On the other hand, the whole approval for commodity as far as when it's given to equity exchanges also provides opportunity on the consolidation front. What's your idea of consolidation? Let me ask you that before I come to the next question.
So I think our view is that the regulators have opened up multiple opportunities for exchanges to look at. We see ourselves as a universal commodities exchange. We genuinely believe that the next wave of regulatory changes which will allow spot exchanges to come up in the commodity space will be something that we will eagerly look into. So from our perspective, our ground still remains commodities, whether it is the derivative or the spot. But in terms of other opportunities, we will evaluate them, but too early to say whether we will try and enter any one of them so soon.
If, you know, given a chance to explore inorganic opportunity in terms of a merger with one of the exchanges, would MCX look at that opportunity seriously, actively? What's your stand at this point of time, looking at the market scenario currently?
So I think one, we've already clarified our position in terms of any corporate actions, and I think that continues to remain our position. There's nothing more I can add.
Okay. Market regulator SEBI also in its very last board meeting allowed custodial service when it comes to the institutional investments in commodity derivatives. Mutual funds being one of them as per the classification. If mutual funds and other institutions, you know, start investing into commodity derivatives, how much of an incremental liquidity in your understanding would it add? How much of depth would it add when it comes to the commodity trading itself?
So I think we have to look at the impact of institutions slightly differently. I don't think we should continue to focus on turnover-based impact, because I think that's not what we expect long-term investors to add. What I think they will add is an tremendous amount of depth to the market. And there are two things which I think we should look at. So I always take this example that, our firm belief is that, if you were looking at the gold ETF, which is a product which is available in India, which trades in India, that product would do much better in terms of its efficiency, costs, and even returns if that product was to invest in commodity derivative instead of holding physical gold. Right. But if you then take and extrapolate the amount of the size of the ETF that is there today, and translate that into open interest, today we have, and we're very happy that our open interest today is in excess of 19 metric tons, but you could easily touch 30 metric tons if all of the gold ETFs were actually using commodity derivatives. So enormous amount of depth will come in. Second, just look at what the SIPs have done to the equity markets. I think we heard today at the ANMI conference as well that people are talking of a 1 lakh crore inflow every year. I mean, even if people were to diversify a couple of percentage points, that's the amount of long-term wealth which would come into this business. And I think most importantly, and that's one thing which all of us expect, is that when it is long-term money, it will chase longer tenor contracts, and I think that is the benefit. So I think institutional investors will bring long-term liquidity and will bring greater open interest into all our contracts.
What's your view as far as market making when it comes to commodity derivatives is concerned? We've spoken about this in the past. How important is it at this point of time when we are at this juncture, when we are talking about commodity derivatives and increasing the depth in this market? What is the kind of desperation which this market is in as far as market making element is concerned?
So I think, I guess, since we firmly believe that commodities are much more global in nature, if we look at the global experience, it is really a 50-50. I mean, you look at all the large commodity exchanges, there are about 40-50% contracts which have done well with liquidity enhancement schemes. And there are equally number of contracts which haven't really done anything, even in spite of having liquidity enhancement. So it is a mixed bag, and I think in terms of the experience in India as well, it's turned out to be a mixed bag. So I think at this point of time, as you're aware, we had said this after we discontinued the liquidity enhancement scheme in our gold options contract, was that in India, it's always a long-term game. It's something where you need to work with the market, educate more people, educate investors, educate the hedgers, and get more and more people onto the platform. That's something which requires lots of effort and some time, but market making may not be the best option for that.
Equity exchanges being allowed to start commodity trading. It's been 3 months since then. What is your understanding? Of course, they haven't gone into agri-commodities so far, but just an understanding and a foresight as far as that is concerned. What kind of competition would this bring? Would it be a very aggressive competition for existing incumbent players like yours?
Right. I mean, first thing is that NCDEX has been in the commodities business for over 14 years. So that's a long track record. Right. And the other exchanges are just starting up. And our experience goes deep in the sense we understand commodities. We have handled deliveries across agricultural commodities, which are perishable products. So there's all the more difficult. Right. And we've handled about 100 lakh tons of delivery over the last 14 years. So there is a lot of, it's not just about trading and trading systems, it's about creating this ecosystem of warehousing and the trust in how the product is handled. And it's good that other exchanges are coming in because at a generic level, the commodity markets need possibly or have space for other players as well to come in with new products and build it, and that's always a welcome thing. Competition helps us also become sort of sharper, stronger, help the customer service go more to a higher level.
Now, of course, it's about 2 exchanges which have entered commodity trading, NSE and BSE. As these 2 exchanges spend more time on this turf, they scale up their commodity trading business. How rapidly would this lead to a transfer of market share when it comes to the incumbent players. What's your sense in terms of just the market dynamic when two new players, such big players in equity space, come into the commodity market?
Yeah, actually, I mean, the nature of most of these derivative markets is there is a lot of stickiness. Liquidity doesn't shift very easily. We've also tried in the past to switch liquidity from the other exchange. It's just doesn't happen. We've had other strong exchanges being set up earlier, like ACE, which haven't made a dent and have had to close. So, and they came with strong parentage as well. So, I think what instead of shifting of market share, I think what might happen is that they may focus on another set of products, or another set of underlying products, commodities, on which they build. So ICEX, for example, has worked on some of them, which we don't trade. So that's, I mean, if these large exchanges focus on those, I'm sure they will find some success. Yeah,
absolutely. Competition is one aspect of the story. The second aspect, of course, is the point of consolidation. It's been 3 months and there's already a lot of speculation in terms of how consolidation would shape up in the commodity space between exchanges. What's your idea? Is that an idea which should be given its due credit in terms of exchanges coming together to essentially bring the right synergy together?
Yeah, I think the purpose of the regulator has been to enhance both development and bring strong players. To that extent, of course, if you're not strong enough, maybe you either exit or consolidate. But so the growth path for us is very strong. We see the opportunities to be big. As far as new products are concerned, certainly we're working on a few, but it takes time because you have to do all the research. You have to make sure that it is there is a significant trading interest.
Which would some of these products be?
So we could look at, for example, paddy as some of them. Some of the other pulses are also
in the pipeline. One last question. Bombay Stock Exchange, it's already listed itself on the exchanges. MCX is listed, NSE is in the process in trying, to get all the regulatory approvals. As far as NCDEX is concerned, what are your plans as far as listing yourself on exchanges is concerned?
Yeah, we have no plans as of now. I think we've got the capital that we require for our near-term growth. So yeah, I mean, obviously it's something that is in terms of direction maybe useful in the sense of if it's freely traded, it possibly helps, but no, from our perspective there are no immediate plans towards that.
Okay, thank you so much for having this conversation. Thank you.
Those were the titans of the Indian Stock Exchange market speaking exclusively to CNBC TV 18. And with that, it's also time to wrap up this special edition. From all of us here at CNBC TV 18, goodbye and thank you so much for watching.